Hello everyone, welcome to the latest TM Brunsdon market update. I hope that you're all keeping safe and well as we gradually ease out of lockdown. I'm pleased to have with me once again Mark Shields, Investment Manager from Brooks Macdonald, who will be answering a few topical questions. Welcome, Mark.
Hi, Brian.
Good morning. Mark, as we move into the second quarter of the new year, I'd like to run through a few questions our clients are asking at this moment in time.
Sure.
The first one is with regard to technology. We've seen areas such as technology come under pressure over the past few weeks. What are the reasons for this, Mark?
Yeah, that's very true. We obviously having had a very strong run in 2020. We've seen technology being a little bit more lackluster in 2021. As investor attention has sort of refocused on more of the cyclical companies that are out there rather than those high growth technology names. There's been a couple of catalysts behind this. The first one is probably, to be honest, as much as anything, the fact that technology's performed so well that there's a degree of profit taking, a degree of investor rotation away from those names. But also we've seen the yields on sovereign debt, especially in the US, spike up. And what that means is that essentially, if the yield on a what is deemed to be a safe asset, such as US sovereign debt, increases, it means that the attractiveness of risky assets such as technology become less appealing, and essentially it therefore has a knock-on effect that the valuations of those technology companies are not as compelling as they once were when yields are very low. So we've seen a little bit of pressure on the technology space. It has been largely, or it's been more pronounced in the very overvalued parts of the market, the technology space. Some names such as Tesla have come under particular pressure, and actually we don't have a huge amount of exposure to those sort of companies in the Brunsdon funds, but it has had a sort of ripple out effect onto the broader technology space in general, and it has meant that technology has lagged more cyclical assets year to date. But as I said, I think our longer term view on technology as a space remains unchanged, and we continue to think that it offers some compelling long-term growth in an environment that we think will pervade over the next sort of few years.
Okay. And how has this affected our portfolios and your positioning of them, Mark?
Yeah, we haven't really made any sort of specific changes to the portfolios on the back of this. As I said, I think technology itself is an area that we want to maintain our exposure to. Yes, it's coming under a little bit of relative pressure at the moment. It's not performing as well as it has done, but we do think that there is a fundamental shift towards certain technology companies, and we want to make sure that we remain exposed to them, even if they're having a slightly more tricky period. Also, very importantly, we've been running our portfolios in what we call a barbell approach. So we have a degree of exposure to those high growth technology names on one side of the barbell. And on the other side of the barbell, we've been maintaining exposure to cyclical companies. And at the moment, it's very interesting to see that whilst our technology bucket or our growth bucket is struggling a little bit, our cyclical bucket is performing very well. So, for example, one of the funds that we have in both portfolios, JO Hambro UK Equity Income, is a very cyclical focused fund. It really struggled for sort of 12 months, 18 months prior to November. Then when investor focus rekindled in the cyclical space in early November when the vaccines were announced, since early November, the fund has delivered over 50%. Essentially, we haven't made any major changes to our portfolios because we've been quite sort of well positioned for both of the outcomes, as it were. And we continue to think that at least for the near term, we're going to see a bit of a sort of tug of war between the growth and cyclical spaces. And we want to make sure we maintain exposure to both of those elements within our portfolios.
Okay. And thinking of the future, Mark, and inflation, how do you think inflation will affect investments going forward?
Yeah, this is really topical. It's something that has really come to the fore of sentiment recently, and in fact has been the main driver behind that increase in yields that I mentioned earlier on. There's real fears out there that with the stimulus measures that are happening in the US, the reopening of economies is going to basically drive an inflationary spike, which may well become sort of embedded into economies later on this year, and that is causing significant concern amongst certain parts of the investment horizon. For what it's worth, we may well see yields continue to tick back up. We could see yields on 10-year US Treasury go towards 2%. We're currently at around about 1.6, having been up at around about 1.75, 74. So we might see a little bit more of an uptick in the near term in terms of those yields driven by inflation expectations. But actually, our thoughts are that this inflationary environment is likely to be short term. We aren't seeing data at the moment to make us think that it is becoming embedded in longer term inflationary figures. Central banks, such as the Fed, have been very quick to acknowledge and make sure that investors are aware that they're willing to tolerate a short term inflationary spike. So actually, we think that the environment we have seen for the past few years of low inflation, lower rates is probably here to stay. But we think there might be a short term blip that hopefully the markets will be sort of sensible enough to look through. So we aren't necessarily as worried about an inflationary spike as the broader market is at the moment for those reasons.
Well, thank you, Mark, and thank you all for watching. As always, if you have any questions, then please be in touch. Thank you.